if you're watching this, we'll have had a conversation at least, or you're interested in what the Canadian cannabis industry looks like from an acquisition perspective. For the next 15, 20 minutes, we'll walk you through a few key pieces. Hopefully you walk out of here with the empowerment to take control of your acquisition journey, whether it's to sell or to buy. Today is going to be focused on the selling side. Awesome. I'll let Krista go in a moment. My name is Kara-Virani, one of the co-founders of CannAcquire. I've been around the cannabis industry for the last 5 years. Previous to that, I was in technology at Salesforce, been in cannabis at various different companies, including Lift & Co., Dutchie, helping them scale, as well as Kind, and now really hoping to help some of the retailers that I've worked with over the past 5 years with their exit strategy.
And I'm Krista Raymer, also similar to Baz. We actually met in the cannabis industry 5 years ago. We've been working with cannabis retailers to run profitable retail stores since regulations in Canada launched. And now we're really focused on driving what that looks like from an inventory, merchandising, and people level. And what that has enabled us to do is put together what the quick hit needs are for getting a store ready for an acquisition, as we've worked with retailers who have gone through the acquisition process, as well as worked with retailers who have made acquisitions.
Fantastic. So the two of us came together, created CannAcquire about a year ago. We've been building in stealth, learning a lot, and we're excited to bring you this webinar today to further your knowledge of what's happening across the state of the union, how to actually get prepared once you have this knowledge to either get locked in, loaded into an acquisition, or at least understand what it takes. We're going to walk through the future outlook. Where is this industry going? Where is this market going? Wonderful thing is a lot of markets in cannabis follow similar trajectories. So whether you're in Canada, New York, Colorado, California, Michigan, a lot of these pieces are going to be relevant to you. And then we're going to kind of dive through some of our proprietary information, as well as our templates that we actually sell on behalf of CannAcquire. Awesome. So diving right in, what's happened so far? In 2019, having a cannabis license was like winning the lottery. Initially in Ontario, at least Ontario, Canada, there was 25 licenses. Each of those licenses was effectively like having a lottery ticket. It was very much a limited license market. Over the next few years, fast forward into 2023 October, where we're at today, this is no longer the case. Why? Because there is immense competition in the space, and there's been immense competition. There hasn't been any boundaries or opportunities for retailers to actually protect themselves from another retailer opening up beside them. There's continuously stringent government regulations as it relates to advertising and things you can and cannot do within a cannabis retail environment. They're extremely different from retail environments in other industries. You have retail cash flow challenges. The government entity in Ontario specifically makes this an extremely challenging piece of the puzzle, and it's a cash circus and juggling circus most of the time, as well as more and more brands large scale retailers have come to market. It really has become a race to the bottom. Pricing compressions and very compressed margins are taking hold in this industry that are driving out a lot of small mom and pop retailers that aren't necessarily laden with cash and capital. As well as in today's economy, we're in almost in hyperinflation, and so the cost of doing business is rising. This means that if you are here to stay and here to play, that even to compete, even to stay alive, you're going to need to invest either in capital or in debt to make sure that you can compete. Krista, what did I miss?
No, I think that the commentary around pricing compression and retail cash flow are two really big parts of this. What we've seen are cycles of retailers running into cash flow constrictions, which essentially results in a limitation around purchasing of inventory. And it's with that inventory that you're needing to compete in competitive markets. So pricing compression shows up not just when we have too much inventory in store, but when we have too much inventory that aren't the right SKUs. And then that also gets exacerbated by when a number of retailers are trying to compete for smaller markets. So when you see too many stores in one small community, that ultimately has led to pricing compression because there's a choice to compete off of price. Now, the cost of doing business is rising, and that isn't just looking at the macroeconomic environment of what's going on, but that also includes just the cost of what it looks like to compete. So originally, when we saw stores open, or if we're referencing 2019, you could open up and run a digital menu and be good to go. Now, because of things like SEO optimizations and needing to still continue to acquire new customers for your retail environments, the cost to compete has increased because of marketing expenses, cost of carrying inventory, as well as with the number of retail environments that are open. There's a lot of budtenders making moves around, and that ultimately makes your staffing costs extremely high. So it's a combination of all of these things that has led a number of retailers to want to consider what it looks like to potentially be acquired or even do acquisitions of maybe their competition or grow into new markets. Why this is really particular to why we're all here is because the number of stores that are in these environments need to be able to be sustained by the amount of customers who can be acquired, who can be retained, and where there's still room for us to increase the value of the customer at store level. And so without operating in areas of limited licensing in Canada, specifically markets like Ontario and Alberta, for example, the competition is really high and can continue to be high. And so we are going into this segment of time where it will continue to be incredibly competitive. And there is still an opportunity for more stores to open. Shabazz, what do you think I'm missing in there?
Wow, that was so well said. As you were talking, I was like, damn, you're good at what you do. And I can see why you're the #1 retail consultant in cannabis worldwide. So the only thing I think you missed is the fact that in more in layman's terms, if someone who has deeper pockets than you sees arbitrage and opportunity at the location that you operate in, they're going to come in one way or another. It does not matter. It's only a moment of time. Either they will acquire your store, or we've seen instances of them popping up stores extremely cheap, right across the street, and right beside you. So some of these larger chains, I'm sure you can think of many of them, they're not stopping until they get what they want, and their whole model is built around that. And that's highly, highly concerning, because the last thing that you'd want is for your store to have no value, or to have increased competition, especially at a busy season or whatever the case is. So that leads us to talk a little bit about the next 18 months. Over the next 18 months, store values will decline in value. As Krista said, we're at this very interesting moment in time in a mature market in cannabis. Margins and prices are going to continue to be compressed, and key store locations will be acquired. If you're considering an exit in any shape, way, or form, you actually must start preparing today.
Yeah, it's not about trying to set up everything once you're ready to make that decision. It's that you're going to prepare yourself at any point if the conversation were to be coming up, that you have all of the pieces in order. Now, that doesn't necessarily mean that's a lot of work up front, but what that does actually mean is that there are opportunities for you to stay organized along the way so that you can go into these conversations efficiently. One of the things that Shabazz and I have seen happen over and over again when we go into these is if the acquirer is looking to have a conversation with a potential retail environment, that conversation will only go as well as what the retailer shows up with. So what that specifically means is your ability to be organized and prepared for conversations with acquirers is literally what will set the trajectory of whether an acquisition might happen or not. Too many times we've seen deals kind of go off the rails because there's unrealistic expectations on both sides. And most often, the retailer who's looking for their store to be acquired doesn't have all of the information, and the deal loses momentum.
Yeah. if you were to be acquired today, would you be ready? Is the real question. And if you're not ready, fortunately, it's a buyer's market, and they'll just move on. The nice thing is that we're starting to see a lot of acquisitions in the space. Some more public acquisitions were, Fire and Flower recently, Jimmy's Cannabis early on with High Tide. So we've seen a lot of acquisitions play out, and Krista and I have had the opportunity to be part of a lot of acquisitions. So everything we'll walk through in the next couple slides are really around getting you set up for success today, so that you're ready to sell tomorrow if it makes sense.
So what do you need to have to be prepared, or what does success look like? It's specifically starting off with something called the data room. And this is essentially just a space that lives on a digital platform that enables people to open up and see how the business is performing. With CannAcquire, we've actually put together a list of templates as well as some tools and resources for somebody to set up their data room and have all of the pieces ready for those conversations. Now, data rooms are supposed to be proprietary, meaning that we're not sharing them with everybody. Your data stays there, and an NDA is signed before you give someone access or view of your data room. But how organized your data room is a direct indication for an acquirer about how organized your entire business is. So this is almost like the cover page of the essay. It is wanting to set up your potential partner who's looking to do the acquisition with the information that they need to get a good sightline of the business today.
Absolutely. And the only thing I'd add is a lot of the acquirers we're speaking with don't want to come in and turn around a store. They actually want a store that's doing well-oiled, has their information ready to go, so that they can just take over that store and immediately start on their payback journey. And so, to Krista's point, the more organized you are, the more you have this information readily available, actually showcases your efficacy and your ability to run that retail environment smoothly and efficiently, so that you can sell it smoothly and efficiently. Because again, to reiterate, no one wants, right now in today's market, a turnaround story.
Yeah, there are very few turnaround deals happening. The deals that are being contracted essentially right now is because the acquirer sees potential in the business. And that's not that they have to turn around the entire business, it's that it's performing to some level of success today. Usually the measurement or indication of success is actually the profitability of the environment. And then what they're seeing is an opportunity that they either have ways in which they can reduce the operating expenses to drive more profitability through the environment, or they believe that potentially adding the store to their marketing outreach, they're able to increase the revenues being pulled into the store. So let's dig in a little bit to kind of one of the core documents that is within a data room. And that is specifically a store snapshot. So when we are taking a look at doing any kind of acquisition or facilitating any kind of conversations between acquirers and stores, it is wanting to break down the information into core areas so that the acquirer understands what risks or non-risks are built into the business. And so what that essentially means is that they are going to specifically want to see sales KPIs, meaning like, what's your revenue numbers look like? What does the inventory on hand look like? What do the people in store look like who are facilitating the day-to-day business? What type of marketing initiatives are either being completed today or show up in the digital footprint online? So under things like sales KPIs, a lot of the time what these groups are looking for is a measurement of top line revenue, gross margins that have been sustained, the health of the sale of the customer through their average per customer rates, as well as if there's any significant discount rate that is pushing or increasing the sales going through the stores. Shabazz, anything to note from here based off of the conversations that you've had with acquirers or stores?
Yeah, I mean, you nailed it. This is, the more I look at this, is actually such a wonderful store snapshot because it really has everything as an acquirer. But really it's going to come down to right-sizing margins based on industry averages and making sure that you're within that, because that's going to change obviously your profitability, as well as really a key component of what is maybe weighted lower than we think is really that loyalty program, the number of customers, and the average days in between, because that shows that you actually know the area, you know the customers, and you can actually spin and tell a really good story around that to the acquirer, because it might just be that, hey, we're not capturing as much as we should be, or we don't have that loyalty program in there, or we're not running the same type of promotions and things like that. And then finally, I would just still stay in that box, which is like your Google reviews are really, really important. And so from a preparedness perspective, something that you can do today is start getting those Google reviews reflected, and making sure that people see that, because those Google reviews are heavy to show the the efficacy of your store, but also Krista mentioned this and alluded to it earlier, but your SEO is really, really massive, and a lot of that's going to come through some of the reviews and some of the pieces on that. So this is going to give me as an acquirer a really good viewpoint, but you as the acquirer, definitely start spinning this and weaving this story from the marketing lens, because the numbers don't lie, and you have some room to really hammer home the value in the marketing aspect.
Yeah, by filling out this form, usually what retailers have found is that it gives them some direction on areas where they need to focus on the business to be able to increase the price to which they would ask for. Or from an acquirer perspective, it's going to start to be the indications of where there might be opportunities or areas that they're focused on. So if you can be really focused and dial into sales KPIs, inventory, the people, and the marketing aspect, and break it out into those chunks, it's going to make things a little more manageable in what steps you can do right away. The goal of having any of these templates organized is that it's going to enable a clear vision of the data from your environment. We've been in situations where we've introduced retailers and acquirers and them not had a full snapshot of how the store is performing in the last year. That's a big miss and starts to show a potential acquirer that you're not ready or you're not prepared, which could also be a first indication that they might be able to offer less than what the store is valued at. So you're setting yourself up for value, and being able to ask for the most amount of money if your data is organized. It's also going to give a good sight line to the business. And so every acquirer has their goals and why they're making acquisitions. It's your job as an acquiree, or as the store being acquired, to understand what your acquirer is hoping to achieve, so that you can also tell that story back to them in how it's applicable within your environment. And the core thing about having these templates and setting these templates up is it will speed up the process. So oftentimes when we've gotten into these environments where we've introduced groups on one side or the other, the due diligence process or this early initial exploration gets slowed down and loses that momentum because there's too much back and forth around asking for data that's missing from a data room. And so if you can have everything included in the data room, that can really speed up the process and make sure that momentum is continuously moving forwards.
Yeah, absolutely. Well, why don't we go into how this all works in terms of a deal snapshot and what it looks like to get acquired. So what does it actually take to get acquired? So you've done, you understand the state of the union, you've done all the prep to get yourself in a good position. What does it actually look like in terms of getting acquired? So we've simplified this deal cycle quite substantially, and we'll walk through each piece. So the number one piece that Krista and I see in a deal cycle from the retailer who's selling is that they don't necessarily have the right expectations of what could happen in a deal or what they're worth. Your store build was 750. You might just be making a couple dollars in EBITDA. You're not going to get $750,000 for that store. Like Krista said, the main kind of metric is that EBITDA, and then the multiple out from there. And so a lot of the time we see in these introductory calls that there is expectations on both sides that are unrealistic. And so the first call we bring together from the CannAcquire perspective, if you're looking to sell, we'll match you with someone who has shown interest in the characteristics of your store, your geo, your location, etc. And we'll match you up. In that first 20 minutes, that's an extremely important call because that's a qualifier call. That call is really going to showcase on both sides if there's a mutual fit of any kind. On the acquirer side, we often say, hey, let's do some discovery, let's learn a little bit more. But for the retailer selling, again, expectations of what your litmus is really important. But for you, it's really a learning call. Hey, what does this look like? Who am I speaking to? Who's the other end of the person? Who's the person on the other end of the line? And could this be somebody or a group or an organization that perhaps it makes sense to dive a little deeper in with and learn a little bit more? This will be really, really surface level, this conversation. It won't dive too deep into the numbers. After that call and after that conversation, should we agree to take it one step further? Here's where we're really going to a deep dive in terms of the discovery. They'll back up. You'll back up a lot of your numbers that you've told the acquirer about. Perhaps show your data room templates that you've completed. You'll start to talk through leases and what those could look like. You'll start to talk through labor and so on and so forth. And after that, it's really the validation where the acquirer will go into the data room, validate everything that we've talked about, really start to attribute a value multiple to the organization and really start to plug it into their formula so that they can start to calculate things like their payback and their margins and how they want to operate. Obviously, after that, pieces such as like inventory come into the mix. How much inventory do you have on hand? Things like that. Naturally, we have a government body in a place like Ontario that would really, be a key cog in this. And so essentially after the data organization is done, this is really where we start to talk about timelines for, an RSA transfer, timelines for an inventory transfer. So in this case in Ontario specifically, you cannot just sell your inventory to another retailer. You have to actually sell it back to the OCS, and then the acquirer buys it from the OCS. And so there's a few different pieces that could slow these things down that are outside of both sides of control. And that's why Krista and I and the whole CannAcquire team really stress the importance of speeding up the process via the things that you can control, which is really around that data organization. Krista, what would you add to this?
No, and just like from a timeline perspective, those introductions and discovery has a tendency to go pretty quickly and have a lot of momentum. Once the data room is opened up, the acquirer is going to put together a valuation of the business that they believe is valued. It is in everyone's best interest for both sides of the retailer as well as the acquirer to have an understanding of what value they think that the business is worth. Now, if those numbers are really far away, that's where usually the deal will fall apart, and it will be during this data organization section that the deal will fall off the rails. If the numbers are relatively close, it gives the momentum for the conversation to keep going. So it's your job as a retailer to have what your price is. So what is the price that you would be willing to pay or to take? And what value do you think is built into the business today? And doing your own due diligence around whether that is reasonable within the current economic environment so that when you are having a conversation, that these conversations can happen quickly. In most instances, there's some additional outside pressure that has shown up. We've seen retailers not wanting to renew a lease, for example, or having to make a really tough call around what their next steps are or whether they're going to continue to operate a retail environment. That can apply additional pressure to this conversation. So whatever you can do also to reduce that level of pressure on a potential relationship is always helpful as well.
Absolutely. And we'll be there to help guide you through this. The CannAcquire team has gone through a variety of different deals now. We feel pretty confident. It's part of the value that we add on the seller side to really make sure that it's as smooth as possible conversation and overall deal cycle, and would encourage you, to ask us any questions you have around that. as well as reach out at any point. We really are here soup to nuts to help kind of guide you through this, and have had some really happy, successful exits. Can provide some referrals on demand. Cool. So this is the last piece of what we're going to go through, which is really deal structures and how to find the one that best fits for you, because this is really going to affect your multiple and what you get in terms of value, your valuation. So cash is king. We've talked about that a lot at the beginning of this webinar. It's a very expensive place right now in the world, and so cash is absolutely king. There are not too many folks offering cash right now, but we have seen all cash deals. These typically tend to come with lower multiples, as it's very transactional. There's not as much risk. There's more risk on the seller side than your side, and so cash is definitely an offer and a deal structure that we've seen. Again, this goes back to kind of the seller's appetite and how much they want you, your location, your store, your operations. And so this is definitely something that we've seen. Second piece is seller financing, traditionally known as more of a VTB or vendor take back. This is often combined with cash, and it focuses specifically on trying to hedge the seller's risk as well as their payback. And so typically what will happen is they'll give you a percentage of cash up front, and then you'll earn the rest of they'll essentially the seller will finance the rest of the deal from you, and you'll earn the payout over typically a subset of anywhere from 12 to 36 months. And so
you mean the buyer?
Sorry, the buyer. Yes, the buyer.
Yeah.
So typically that would come as a loan, and prime plus X% or whatever the case is. And the third and fourth piece, or equity financing. So we've seen deals that have happened for shares and stocks. Typically, this will drive up the EBITDA multiple, as it's not as liquid in terms of actually getting that money, and the seller has a lot more to play with in this instance. So you might see 3.5, 4 times EBITDA deals here, and then the final piece is really around bank financing. Chris, I'm sure I missed a lot, and apologies for that blunder, but tell me, tell us what we missed.
No, I think you made a distinction around the EBITDA multiple that I think is helpful to track it across these deal structures. So from a cash offer perspective, right now, what we're seeing in the market is kind of in the range of 2 to 4 times EBITDA, and that would specifically on the higher multiple side, that would show up in an area where maybe there's some restrictions around licenses. On the lower side, that could be a reflection of kind of where there might be a lot of competition. The opportunity from a cash offer right from the outset, unless the deal is that low value to begin with, it's very unlikely. A lot of the deals that we're seeing start as maybe a stock or equity conversation and transition maybe to seller-based financing, or there's different types of groups trying to structure different deals. So there's a number of acquirers who are using stock or equity-based financing and will pay a higher multiple, but don't necessarily involve any significant outlay of cash. So for you, as somebody who's wanting to sell, there is less cash in the game in the short term. So if cash upfront is something that you are wanting to explore, the cash offer or seller-based financing are often avenues to do that. If the acquirer is using bank financing, there would be cash potentially on the table there, but there are very few banks who are offering this level of financing for acquirers right now. And so that has not been something that we've significantly seen in the marketplace. Seller-based financing can also sometimes drive up that EBITDA multiple, or there is actually opportunities for you as a seller to make interest on the payments that the buyer is is looking for. So for example, you could be structuring a deal where maybe they're going to make payments over the next 3 years. You can actually be making interest on the loan that you've given to the acquirer in that process. And so there is avenues to have some level of cash flow that happen throughout the process of that deal.
Yeah, either way, you got to think about, what your timeline is for exiting, what your risk tolerance is for exiting, and what you value and how much you believe in the person essentially acquiring you is a real key, and that's a criteria as you think about really getting acquired, because everyone's in different positions.
Mm-hmm.
So that's all we had for today's webinar. This is the first, I'm sure, of many. Really, our goal is to continue to educate, continue to be this piece in the middle, trying to essentially market make. We have a lot of insights on our CannAcquire blog. That's where we showcase a lot of the content. A lot of the things we learn are straight from deal cycles and the humans that we talk to and being in the trenches. So I would encourage you to check out our blog. If you have any questions, check out CannAcquire@gmail.com. And of course, we're always adding new pieces to our website. And if you're ever curious about how to get in touch with us, forget the Gmail account, just hit us on the website and we'll get that inbound and we'll contact you immediately. Thank you so much for joining us. We really hope that you found a lot of value from this. And we're really excited about the future of cannabis and cannabis retail. However, this is just a necessary piece of the puzzle. And we just want to make sure that you understand that you have the resources and you have an organization there who understands it and who's going to help kind of rear you through this. Krista?
No, I think that what we've essentially gone over is that this is going to continue to be a really competitive environment for the next 18 months and potentially even longer than that. And so as owners of these businesses, it's really your responsibility to understand how much you want to participate in that. And that's usually what drives kind of next conversations around if, one, you're wanting to sell, and two, CannAcquire is the right solution for you, and that we're really just out there making sure that you're getting matched with potential acquirers to have the right conversations.
Awesome. And the final thing we'll say is we do sell these templates and we do sell a few different pieces of what we do. So we'd love to have the conversation if you enjoyed this webinar and see how we can work together.